Go.
Hello, everyone, and welcome to Group 7's presentation on Sun Microsystems and our assessment on whether or not Oracle should acquire Sun Microsystems. Next slide, please. Is Sun Microsystems a strategic fit for Oracle? Our short answer is yes. The move to acquire Sun Microsystems would be a strong acquisition for Oracle pending analysis, which will follow up on subsequent slides here. Now, currently, the companies that are attempting to produce in-house software and hardware consist of Apple with their Mac line of products, Google with their Chromebooks, and Microsoft with their Surface line. There are companies like Procore and Smartsheet that do produce their own software for business technologies. And so Sun Microsystems could definitely work alongside Oracle to produce products in the same vein as Apple, Google, and Microsoft. Next slide, please.
Thank you, Victor. Now we'll talk about the valuation approach. The hardware market is known for its high barriers to entry and predictable cash flows, making the DCF model an ideal choice. Even though in the 2008 recession, the hardware market demonstrated steady growth, but the software market suffered significantly. Thus, we consider the stability for the long term is in the hardware sector. In summary, given the high barriers to entry and predictability of the cash flows in the hardware market, and considering the Sun's primary revenue source, the DCF model is the recommended approach for valuing Sun's value. Now, we will jump into details of the valuation assumptions. First, we have the CapEx module, which we work from Exhibit 14. We will take the CapEx with the formula above. Also, we need to consider the main assumptions we are sensitive to the model. Any changes to any of these four variables, which is the tax rate, net working capital, terminal growth, and WACC, has a significant impact into the net present value. Later, we will see with a sensitivity analysis how the WACC and terminal growth impacts this NPV. To calculate the target's WACC, we use our WACC module. Every piece to the equation is explained with a reference. Our WACC is 12.72%. Another important assumption is the net working capital. The choice of net working capital assumption can significantly impact the valuation outcome. In this case, our assumption is 25.9% of sales for the next 5 years. The last year, which is the terminal year, we assume that the net working capital goes back to the company. In addition, we had to calculate our terminal growth. We use the sustainable growth rate model, where we assume the company holds its earnings at 100% or they don't pay dividends. We took the average of the last 2 years of rate of return of equity, and that's our growth of 3.56%. After plugging this growth to our terminal value equation, we get a present value of 2373 millions. For the cash flows, we use the EBIT method. The EBIT method in the DCF model provides a way to assess the value of a business based primarily on its operating performance, without being significantly affected by variations in capital structure or financial leverage. With this method, we calculate the share price of $6.39. With our sensitivity analysis, we can see different scenarios. The most positive scenarios, the Oracle should not pay no more than $8 per stock, and this is because the growth rate is kind of low, and also because it's losing market share in the software business. Now I will pass it to Victor.
And so for additional analysis on Sun Microsystems, comparing it to the rest of the industry, we see this table down below that shows the levered beta, the debt to equity ratios, EBIT multiple, EBITDA multiple, and their sales multiple. Next slide, please. While still looking at the table provided in the previous slide, we will now be able to explain that with the levered beta that is above the industry mean, this indicates that Sun Microsystems is riskier than the rest of the market in terms of its investment value. Its debt to equity ratio is well below the industry mean, which would tell us that Sun Microsystems is actually operating on a less riskier level compared to the rest of the industry, although their levered beta suggests otherwise in terms of its investment value. And with the rest of the values, such as EBIT, EBITDA, and its sales multiples, with those being drastically lower than the rest of the industry, it would indicate as an investor that Sun Microsystems actually would return a substantially lower earnings yield for Oracle should the acquisition take place compared to the rest of the industry. Next slide, please.
Now I'm going to introduce some of the synergies that appear from the Oracle Sun deal. Although there are many approaches to identify, our team mostly focus on two approaches: cost reduction and revenue enhancement. Regarding cost reduction, we identify possible reduction in staffing and SG&A expenses, which can be reduced by 20% and 22% respectively. We expect the decrease in these overhead expenses can be realized as soon as the deal is completed. As for revenue enhancement approach, new products combining Oracle's expertise in data management and Sun's strength in hardware servers are the biggest driver of synergy value. We know that one of the projects Oracle is exploring is building a transaction processing database machine. The combination of Oracle software and Sun's FlashWire technology will make this machine leap over IBM's. We'll present more details with numbers for the synergy value in next slide. Additionally, Oracle is also able to add the famous Java software and Solaris platforms to its suite of software. This enables Oracle to attract customers from different spending levels. Our confidence is from the internal market surveys conducted by Oracle, showing customers positive willingness of paying for downloads. Now let's look at the numbers projecting the value of these synergies. Next slide, please. Based on the projected cash flows from the synergies, the $45 million loss in operating income is expected to be a short-term pain of the acquisition and won't have a recurring impact on later years. And let's look at the potential addition to operating profits and integration charge associated during the implementation. On the profit side, it's anticipated it will take a 3-year time span to kick into full gears. So we assign a different weighting for each of the 3 years, which is 15%, 25%, and 60% respectively, out of the maximum forecast of $900 million annually. The rationale here is that along the process of integration, the synergy will generate more profits in an increasing velocity. On the charge side, we match its time length with the profit, which sunsets in 2013. Since the majority of the integration charge will be realized during first year, we think spreading out the remaining equally represents a neutral perspective in forecasting. Before turning to the next slide, let me briefly walk you through the calculation of adding synergy value into Sun's equity value. We combine the NPV of synergy value between 2010 and 2013 and that of the terminal value starting as early as 2014, assuming that 2014 is the start of perpetuity without constant growth. Then we add this additional NPV into the base case enterprise value calculated by my teammate Romulo to arrive at new enterprise value of $8,648 million. For the rest of the calculation, we follow the same method to obtain a new share price of $11.61. Now let's shift our focus to a sensitivity analysis considering synergies. Next slide, please. Again, here we are using the same calculation method as the base case sensitivity analysis in previous slide. The only difference is here we use a new share price of $11.61 to analyze. Based on the results in the table, if the perceived synergies are all realized, the synergies can eventually boost Sun's share price to as high as $13.44. However, we recommend to take a more conservative stand when taking into account the effect of synergies. Last but not least, I'll close our presentation with our recommended maximum offering price for this deal. Next slide, please. If other bidders join the competition, our team recommend Oracle offers a price not to exceed $10.83, which is the average of maximum prices in the two sensitivity tables before and after synergy value consideration. Next slide, please. And this concludes our presentation for Sun Microsystems. Thank you, and we look forward to your comment.